Okay, so, right, chapter 1. Chapter 1, right, was basically the intro to accounting. Okay, so what I want to test from you on chapter 1 is pretty straightforward, right? Let me go ahead and grab my review sheets open. For chapter 1, all I really want you to know for chapter 1 is just like the very, 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 very basics of, what at least the general idea of what accounting is, okay? So I'm going to go over this. So chapter 1, so as you can see, right, there's a lot of information in chapter 1. I'm not going to go into way too much detail because all I really want you to know is just the general information, like what are the 5 business organizations, right? I don't need you to go into depth because the one that we are primarily looking at is going to be a sole proprietor. However, for chapter 1, I don't need you to know into too much details. I just need you to know like the basic information, like what are the 5 different organizations, what are the different business activities, what are the 4 financial statements, things like that. What are the areas of accounting? And that's pretty much it for chapter 1. So you can kind of guess that maybe the chapter 1 is probably 5 questions, just because it's overloaded with a lot of material that I don't need you guys to memorize. I just need you guys to memorize just only a few key things, like, okay, well, which type of business are we focusing on? We're focusing on sole proprietor, right? What kind of accounting are we dealing with? We're dealing with the private accounting, okay? So just understand that much, okay? So here, let's go ahead and answer the questions, okay? So this is going to be similar to what I could ask you on the exam. They will not be obviously word for word, but it's just the general idea of, testing on what you actually know. So for the first one, what is accounting? Letter A, okay? It's the process of recording, sorting, and summarizing all business transactions, okay? Yes, as you guys know, it isn't the process of creating formulas. It isn't the process of elimination, nor is it the process to collect data, right? So we've seen this question before. That's good. A, as long as you understand that it's analyzing, sorting, summarizing, interpreting, collecting, it's all of that. Right. Number 2, okay, which of the following areas of accounting does financial, managerial, financial planning, and treasury accounting belong to? C, government. Okay, not so much for government.
Then it's public accounting.
Okay, so it's definitely not public accounting, because most likely for public accounting, you'll see only 3 large areas, right? Auditing, taxation, and forensics.
You just mentioned that we're going to be focusing on private accounting, so is the answer private accounting?
Yes, it is. But if you look in chapter 1, okay, under private accounting, you're going to see these areas are going to be there. Or you're going to see these types of accounting jobs that exist under private accounting, right? Financial accounting, managerial accounting, cost accounting, treasury accounting. If you remember what treasury accounting is, it's literally a bank teller or a bank bond seller, right? It's real simple, general people that do accounting. Okay, and for these types of accountants, right, they kind of do it for the smaller companies, right? But as you go up into public accounting, where you're going to be working for the corporations, that's where you're only limited to 3 areas: auditing, taxation, and forensics. Okay. So there you go. So private, you kind of a little more flexible here. So private is going to be correct. Okay. Number 3, which of the following is not a business organization?
Going to be D.
D, all of the above are business organizations. Yes, right? We talked about there's exactly 5, right? We have sole proprietor, partnership, corporations, nonprofit, and LLCs. Okay. So good. But yes, all of these are business organizations. Number 4, okay, which of the following financial statements is based off of the accounting equation: assets equals liabilities plus equity?
Letter B.
Letter B, no. It is not the profit and loss.
Is it the balance sheet?
It is the balance sheet, right? Hence why you need to have an equal sign, right? If your assets equal your liabilities and your equity, imagine it on a scale, right? You're balancing your assets to make sure that your liabilities and your equity are equaled out to each other. So, yes, if you think of it that way, that is correct. Okay, so profit and loss. I guess maybe we should go over the PowerPoints again. So profit and loss, right? When we talk about how we determine profitability, right? We're gonna take all of our revenues that we generated for the business, and we're gonna counter them against all of our expenses. Okay, so that's the profit and loss, because that way we can determine, well, did all the money that I generated, did it cover all of my costs? And if it did, then I get positive. Then I gain a profit because I it covered all my costs. But in this case, right, if I wanted to determine whether I got a loss, right, maybe I didn't generate enough revenue to cover all my costs, then I have a negative number, which then tells me that my costs were way too high for this accounting period. Okay. And then statement of cash flows, right, is where you are going to be converting your accrual accounts to cash basis. So actually taking a look at how much cash is flowing into the company versus how much cash is flowing out from the company. Okay. And then, of course, lastly, but statement of equity is going to be determined by your net income or net loss, right? And any contributing factors, whether that either increases or decreases equity. So any capital contribution, right? If you add your own money in there or your own investment, you'll increase equity, right? The value of your company. Or if you take away money, right? If you do an owner's withdrawal, then you are going to be taking money away from the company. Okay? So then, question number 5. Okay, what is the difference between the accountant and the bookkeeper?
A.
A. Accountant records, creates financial statements, and analyzes business transactions, okay? And while the bookkeeper only records. Yes. Remember, the bookkeeper has only one job and one job only. They only need to record business transactions. The accountant does pretty much everything else. So that is correct. Okay. Okay, so the next section is chapter 2. What I'm going to do is I'm going to actually go over the PowerPoints. I think we need a refresher here. So I'm going to go over the PowerPoints and then we'll go from there. Okay. So let's dive right into chapter 2. Right? Here is chapter 2. So, once again, we took a look at what accounting is. You need to understand the definition, right? We know what the definition is. It's to record, sort, and analyze and interpret financial information or a business transaction. Okay? We need to understand that there are a total of 5 account types. All right? Only 5 and 5 only. All right? You have your assets, your liabilities, your equity, your revenues or income, whatever you want to call that one, and your expenses. Okay? There are only 5. Okay? And each one serves a purpose in, of course, accounting and business when we understand it. Okay? Now, what I want you guys to get away from here is that the first 3, which is your assets, liabilities, and your equity, those are going to be your permanent accounts. They never close at the end of a given period, okay? For example, your bank account or a bank loan, right? When you reach the end of a given period, you never close it out, because if you close out your bank account, what does that tell us? It tells us that you closed your business, right? You can close your bank loan out, but they're still going to go after you for their money back, okay? So these will never ever close out to the end of the given period because of what kind of context they are, right? Where your temporary accounts are your revenues and your expenses, right? A great way to understand this, right? Revenues is what you generate or what you create income for your business. So when we deal with revenues, right, that's a way that we try to earn our money, okay? And then expenses, right, are things that we need to spend or use in order to operate our business. So in this case, right, they close out at the end of a given period, hence the word temporary accounts, is because you'll in context, right, when you generate revenue, will you ever generate the same revenue every single month? No, right? You will have new customers, you will have old customers. Your old customers, they might be a regular customer that orders the same thing, but one day they might come into your store and say, hey, I want something new. You can never predict what your total revenues can be every single month or every single accounting period. Same thing with your expenses, right? Of course, you'll have your fixed expenses like rent or utilities, right? Water could just be a flat $50 every single month, no matter how much you use or how much you don't use, right? Internet expenses, right? Those could be unlimited, so it doesn't matter how much you use. Those are going to be fixed expenses. However, things like, oh, okay, for the month of July, I have a 4th of July sale. So I'm going to go ahead and purchase some advertising expense for the month of July. But then in the month of August, there is no holiday. So therefore, your expenses can vary as well. All right? So again, we're going to break down to this. Okay, for this section here, I don't really need you to really truly know this section too much, just because this is more for understanding how we organize the chart of accounts or how we organize our accounts. We organize them like we have them as chapters, right? You have an overall book. If each chapter is split up, then every chapter will have, you know, smaller concepts, right? And we treat this as main accounts, sub accounts, and contra accounts. As we know, main accounts, right, is pretty much like the umbrella organization, or it's like a broad type of account. So, for example, a main account could be inventory, right? Now, a sub account is going to give the main account more detail. And how does it give more detail? It breaks the main account down into further detail. So, for example, right, inventory. I can sell coffee mugs. I can sell toys. I can sell a specific item, and that's going to be my sub account. Okay? Now, a contra account could give the main account even more information, or it could be a contra sub account. Okay? Now, what a contra account does is it flows or it decreases the main account. So, for example, right, we took a look at sales. In order to decrease our sales, we need to create a contra account called sales returns and allowances. Okay? So, for this one, I just need you guys to know the basics of just what they are versus understanding and understanding how it is organized and things like that, right? What are these accounts? Okay? And how are they broken down?
Okay, excuse me.
Mm-hmm.
With the sub account,
Mm-hmm.
okay, like you said, it could be mugs, it could be what potato chips, whatever. Would do you create a sub account for each individual item to break
Uh,
it down? Is that what the sub would be used for?
yes, right,
Okay.
right. So, for example, right, my main account is inventory. Inventory could be anything, but if you are a big store and you're just gonna say, I'm selling inventory, right?
Mm-hmm.
And you have, let's say you have 10 items. How are you going to keep track of your 10 items if you're just going to take everything out of inventory? How do I know how much I have of each item? That's where I'm going to go ahead and split the main account, such as to make a sub account to
Mm-hmm.
further to understand. Okay, when I have inventory, right, which is my main account,
Right.
I sell under my inventory, or the inventory items I have is my coffee mugs. Okay, and the general rule of thumb here is they usually flow in the same direction. So if my inventory, which is an asset, normally is debited, so will my sub accounts underneath it. Okay.
Okay, I got it.
So think of it like this. So inventory is chapter 1. Sub account is going to be section point 1, understanding what accounting is, right? It breaks the chapter down even further.
All right, I got it.
Okay.
That's a good example.
Okay. So here, right, things that you should know. Left means debit, right means credit. Never refer them as increase or decrease, because in context, you need context to kind of determine which flow or which direction each account is going to flow in, right? And when we get to the normal balances, we'll further on what it means to have an increase and decrease, right? But always refer debit and credit as left and right, okay? It's because the way that we look at our journal, right? You have a column on the left for debits and a column on the right for credits. Simple as that. But just understanding in accounting, we refer it as debit and credit, left and right. Okay? We need to understand what the accounting equation is, because it is the fundamental backbone of everything you need to know for business, right? You need to make sure that your total, everything that you own, is going to be equivalent to everything that you owe plus the value of your company. All right? This statement must hold true, and the way that we test is towards the end of the class, or the end of the accounting cycle. You guys remember that. is that you guys will eventually have to test this equation through the balance sheet. Okay? So then assets, liabilities, and equity. So again, assets. Assets are everything that you own, okay? And it's crucial that you know that assets only has 3 categories, okay? They only have current assets, fixed assets, and other assets. The way that we organize assets is going or by category, right? Is typically by how readily available it is in cash or how liquid each item is. So again, if you look on the right side, right, for example, my current asset, first thing you're going to have there at the top of it is going to be your cash, your bank account, accounts receivable, right? Those are all things that are already in its simplest form. It's already in cash, right? And then the next section here is going to be your fixed assets, right? Your fixed assets, also known as property, plant, or equipment. So anything, so property, right, is the land, it's the street, it's the lights, lamp post, it's the sidewalks. That's your property, right? It's just where everything is, right? It's the lands, the area, the sidewalks, the parking lots, okay? That's going to be your property, okay? Where your plant, right? Plant is going to be your building, all right? Your plant's going to be your building and everything that's in it. So, furniture, equipment, or I'm sorry, like the office equipment, such as like printers, right? Things that help you run your business, okay? But for plants, right? That could be the building itself, right? The lights inside the building, okay? The furniture, the desk, the tables, all of that is going to be considered part of the plant, all right? And then, of course, equipment, pretty straightforward, right? It's any type of machinery that you use to operate your business, okay? Again, those are going to be your fixed assets. And of course, if you think in context, right? When you buy a building, how long is it going to take you to convert it into cash? It could take anywhere from 6 to a year or even a year and a half because you have to go through escrow, you got to go through appraisal, you have to go through the bank to make sure that both parties have enough money to go ahead and transfer ownership, okay? You have to sell it out in the short market, right? And maybe some people aren't buying buildings, so it could take you a long time to even sell it, okay? So the main idea here is that this kind of context, it takes time to sell, all right? Other assets are going to be usually anything other than a current or fixed asset. Key feature here is most of other assets are going to be identified as intangible assets, right? Things that you can't physically touch, all right? So in this way, we have things like deposits, okay? Prepaid accounts, things like copyrights, license, contracts, anything like that, okay? Because, for example, right, a deposit. If I made a deposit for my rent, okay, how easily are you able to get that money back? Sometimes you may have to fight with the landlord to get your money back. And on top of that, it's not easy, okay, because most landlords, they treat the deposit as an emergency for in case anything happens, such as, oh, my plumbing went out. Okay, great, you made a deposit, right? Things like that, okay? And they're typically most likely not going to be able to get your money back as soon as possible, right? So that's your assets.
That's funny.
Liabilities, okay? Liabilities, there's only 2 categories under liabilities. Now, how we understand liabilities is we need to understand that it's not debt to the company, all right? So that's English terms, right? When we look at what we owe people, that's considered debt. Now, in accounting terms, we consider them as obligations, right? Because when we owe people money, it's an obligation that we are subject to pay, all right? I mean, you can determine, right, debt as something that you're obligated to pay, but sometimes you don't pay. So I guess that could be a kind of difference. But in this case, you're obligated to pay these people because you're a business. You have a bunch of cash flow, and if you don't pay, they're still going to go after you. Okay? All right? And we have to understand that liabilities are split into two categories: current liabilities and long-term liabilities, okay? Not short-term and long-term, right? It's current and long-term. So when we organize or categorize our liabilities, we understand them as how long are we owing this person, okay? So current liabilities are going to be within 1 year, okay? So anything such as if you have a credit card, right? Of course, it's going to be split into 5 years, but they expect you to make monthly payments. So in this context, right, they're forcing you to pay every month. That is going to be a current liability, right? Most places that give you accounts or they bill you, usually they bill you and they expect you to pay within 30, 60, 90 days. That is less than a year. And another good example would be sales tax, right? No government's going to let you keep the money for over a year. They're going to expect you to make either monthly or quarterly payments for state taxes. Okay. And then, of course, long-term liabilities, straightforward. Any typical loan is going to be one because loans can be anywhere from 1 to 30 years, right? A typical home loan nowadays could be anywhere from 25 to 36 years. Same thing here. A business loan could be anywhere from 5 to 6 years or 5 to 10 years, depending on how much you owe and what your credit score is and how much you're willing to pay back. Now, of course, long-term loans, right, will also accrue interest, but that's how you are going to determine it, right? You're going to determine it as something that's going to be that you're going to owe for more than a year, okay? Now, of course, if you are looking at a short-term loan, it's going to be in its name. It's going to tell you it's a short-term loan that's for 6 months only. Then, obviously, that's going to be a current liability. But yes, in other words, that's how you're going to determine and categorize your liabilities is based off of how long you're going to owe. Okay. Last but not least, not last, excuse me. Equity, right? There are no categories under equity, okay? Here, this is just examples of what equity can entail, right? Things that can affect whether it could increase or decrease equity. So, when we talk about equity or the statement of equity, right, we understand that as a sole proprietor, looking at a small business standpoint, this is what you typically will have. You will have things that will increase, such as capital contributions. So whether you invest your own money into the company, that's a capital contribution. Okay? But if you take money away from your company, then that's considered a withdrawal. All right? And that's going to change the value of your company. So equity, as we understand it, right? It's different from property management, okay? Equity that we learn here in accounting is going to be the net value of your company. It's not what you gain, it's not what you profit, it's what is the value of your company. Okay? And what changes the value of the company will be whether you invest money into the company or you take money away from the company. Okay? For a home, obviously that's different. You gain equity by living on the land for as many years, right? You create equity. in context to accounting and business, you have to make your equity, whether you add your own money, take away money, or you reinvest by investing your profits into the company, which again, you have your income, right? Income is usually determined as all of your revenues minus out all of your expenses. Which now we're going to talk about this, right? Revenues is pretty straightforward, right? Revenues is anything that we generate to make money in our company. So when we make a sale, okay, when we sell our products out. So in this standpoint, right, we're looking as if the view of a merchandising type of business activity where we sell a product instead of provide a service or create the product. We sell the product. So most cases that you'll see oftentimes will be a main operating revenue, which is what is the main core of your generating money, which is going to be your sales, right? Because you're selling a product. Anything other than that, categorized wise, is going to be other income. So anything that you generate that isn't the main core of your operation. So if you're not selling a product, let's say you do deliveries, which isn't part of your main core, right? You're trying to sell products, not deliver it. Then that's going to be considered other income. Or other words, you could also treat it as non-operating income or non-operating revenues. Where your expenses, right, is broken down to three categories, right? We don't learn non-operating expenses in this class because that's more advanced level of accounting. So you really only need to focus on two: cost of goods sold and operating expenses. Cost of goods sold we talked about before, right? It's directly correlated to selling a product. So in this case, your cost of goods sold, right? Literally, what is the cost it takes you to sell your goods? Okay? So that's going to be your inventory, directly correlated to your inventory. Okay? Operating expenses is going to be everything it takes to operate your business. So again, rent expense, purchase expense, advertising expense. Okay? Then now we have to understand the nature, the normal balance of, or in this case, the accounting model. We understand that the normal balance of each account is going to be determined as which side does it increase on. So in this case, it's referring, for example, my assets, right? Which side does it increase on? Well, in this case, let's take a look at my arrows. It looks like my debits increase my assets. So that is how we determine what a normal balance is. Okay? Normal balance, it's going to be the side which increases on the positive side for. So in this case, right, like I mentioned before, your assets are going to be increased with a debit, and a credit is going to decrease an asset, right? But that's exactly why we don't refer debits and credits as increase or decrease, because in context, right, if I look at my liabilities, my credits increase my liabilities while my debits decrease my liabilities, okay? So memorizing this, straightforward, just understand that my assets and my expenses are increased by debits, okay? While everything else, so the other three, revenues, equity, and liabilities, are increased by credits, okay? So if I ask you what is the normal balance of an asset account, you will tell me debit. Okay. All right, bookkeeping system, right? I'm not going to test you too much on this. Just make sure that you know the difference between the two, because we will be looking at both sides, okay? Especially when we dive into QuickBooks, right? When we dive into QuickBooks, we're going to be taking a look at the single entry system, okay? Where we only record one way, okay? Whereas in accounting, right, the best way to teach you accounting is to use a double entry system where we have one, well, we know where our money's going, right? If we're using cash, right? If we write a check, in our book. That's one way of saying, okay, I'm taking money out. Now, the second part of that double entry is going to be your equal and opposite debit and credit is going to be where did you spend that money on? Okay? So one is spending money, the other one is where you're spending money. What are you spending on? So in this case, we have to understand that our total debits are going to always equal our total credits. Okay? So that is chapter 2 for you. Once again, I have the review sheets for you. So this is actually going to answer pretty much a lot of the questions that are going to be on the exam. Okay? And you guys are allowed to have this on the exam as well. So let's go ahead and dive right into chapter 2. Now, how I'm going to test you everything for chapter 2 is exactly like this. I'm going to give you a table. I'm going to give you an account. The account will have a little brief description of what it is. And what I'm going to ask you is, I'm going to have you determine what account type it is, what account category it belongs to, and what the normal balance is. So is it a debit or is it a credit balance, okay? Now, of course, how it's multiple choices, if I give you an example, right? I say, what is cash? And I tell you cash is just money that you have in the bank. I'm going to give you A. Choices A through D, right? A is going to be asset, current, debit. Okay? Or it could be a liability, current, debit. Or it could be an expense, operating, debit. Okay? So that's how it's going to be, right? You're going to, I pretty much give you the choices and what you can choose from. So out of the 4 choices, which one is going to be best describing the account? Okay, so once again, use your accounting model because that will help you the most on answering this question right here. If you can determine the account type, you will most likely, using the accounting model sheet, right, the picture with all the arrows, you're most likely to know the answer if you just look on that. Okay? So with that being said, right here, right, question, first section is going to be determining the account type. There's only 5 account types, so, all right, categories, right? You have all the categories here that we just covered. And of course, the normal balance. Is it a debit or is it a credit balance? So let's go over this real quick. Cash. What kind of account is cash?
An asset.
It's an asset. Good. So I'm going to use A for short. Okay. It's an asset. Okay. What kind of asset is it? What kind of category should it belong to?
Current.
It is definitely current. And what kind of normal balance would it have?
A normal balance is a debit.
Good.
Right? Okay.
What about an accounts receivable? Right? We understand accounts receivable is when customers owe us money.
Asset?
It is definitely asset because it's money that's kind of ours already, right? Now, what kind of asset is it?
Long-term.
Is there such thing as a long-term asset?
Is it a current?
It will definitely be current because I can go to my customer and demand my money back. Okay? I can send them letters and say, hey, pay up. Okay? And what kind of normal balance would accounts receivable have?
Normal balance is a debit.
Yes, right? It's an asset. It will normally have a debit balance. Okay? What about inventory? It is definitely an asset because we own it, right? Now, how would we categorize inventory? Yes, it is definitely a current asset, right? Because we can turn it around and sell it for cash. Okay? So, what kind of normal balance would that have?
A debit.
It would definitely have a debit balance. Okay? What about equipment?
That's also assets.
Mm-hmm. What kind of asset?
Fixed asset.
It is definitely a fixed asset. Good, because it falls within the PP&E. So it is an asset and it's fixed. Now, what kind of normal balance would equipment have?
A debit.
Still a debit.
It's still a debit because it's still an asset. Good. Okay. What about land?
Is it an asset?
It's still an asset. What kind of asset?
Fixed.
It is definitely fixed. And it would definitely have a debit balance. Okay. What about a prepaid accounts?
It's a liability.
What was that?
Is it a good?
Is it a liability?
Okay, so this is a prepaid account. Okay. Other words, prepaid rent, prepaid insurance.
It's an asset.
An asset.
Right, because in this case, we're buying the rent in advance, right? We're paying in advance. So we own it, right? Okay, now what kind of asset would a prepaid account have?
Other.
It's definitely other because you can't touch it, right? And normal balance, debit. Good. Okay. What about an accounts payable? When you owe other people or vendors.
A liability.
This is where it's a liability, yes. Now what kind of liability is this? Current. Most accounts payable, right? Like I said, it's where you get billed 30, 60, 90 days. Okay. And what kind of normal balance will a liability have? It will definitely have a credit balance, right? Good. What about unearned revenue? This is where customers pay you in advance for a service.
Would it be an asset? If they're paying you in advance.
Instead of revenue.
It's not a revenue. It's not an asset. So, okay, in this case, right? It's not an income. Okay.
Can you go back up to the choices again?
Assets, liabilities, owners, equity, income, and expenses.
Is it income?
It's not income. Okay. Don't get confused that with this word revenue that's there. What happens when it's unearned? Okay, so a customer has paid you in advance for a service. Okay? When a customer pays you in advance for a service, right?
An expense.
Is that something that you would take the if a customer paid you in advance for a service, how is that how can you apply that as an expense for the business?
Because you haven't provided the service yet.
You haven't provided the service yet, so therefore, if you haven't provided the service, what do? What does that mean if you haven't provided the service yet?
Go back to the choices.
It's a liability.
It's a liability because you owe services.
You owe us. Okay, got it. That makes sense.
Unearned revenue. If a customer pays you in advance for services which you haven't completed, therefore you owe them services. So unearned revenue is going to be a liability.
And it will be current.
It will definitely be current, right? I don't know who would pay you for services for a year later.
Right.
Okay. And what kind of balance would it be?
If they paid already in advance, that would be a debit,
A
correct?
debit?
Now it's a liability. If you are increasing things that you owe, right. Okay. But in context, like you just said right there, you got paid. Now, if I got paid in cash, let's say, what is cash?
An asset.
It's an asset. So we're not looking at the context of liabilities anymore. But you see how we have to take two types of accounts to use the double entry system, right? We got paid for an advance by a customer to provide services. So we owe services in the future. Okay. What about a notes payable?
A liability?
It is definitely a liability, right? Okay. Now, what kind of liability?
Correct.
Current, right? It can be long term as well, right? Because the difference between a notes payable, right? You owe people money. However, you can finance, you can defer payments, you can extend payments. So in this case, it can be short term, it could be short term, or it could be long term, right? It could be determined 6 months. Maybe you can't pay it now, so you request for an extension for another year, right? That's what a notes payable does, is that you can negotiate the time that you want to pay them back. So that's a notes payable. So it could be current or long term. All right. And once again, what balance would a notes payable have?
Credit.
Credit.
Credit. Good. All right. What about owner's equity?
An asset?
Asset.
What was that?
Owner's equity.
Equity has no category, right?
Correct. So it is owner's equity, right? Equity is equity. There is no categories. So in this case, what kind of balance would it have?
It's a credit.
Definitely, right? We understand that equity will have a credit balance. Now, what happens if I had a owner's withdrawal? I take money away from the company.
Liability?
Okay, so if I'm taking money away from the company, am I owing anybody?
It's
No.
expense.
It's an expense.
If I'm taking money away from my company, how is that an expense?
I don't know. I
Owner's
do that from
withdrawal
base.
is equity, right?
It is an owner's equity, right? Because I'm taking money away from my company. Therefore, I'm pulling value out of my company. So if I'm taking away money from my company, that's going to be dealing with the equity itself. Okay? No categories, right? So then, what kind of balance would this account have?
A debit?
A debit.
Okay.
What, were you going to change your mind?
No,
Okay. So in this case, yes, it would flow as a debit because am I increasing or am I decreasing my equity account?
You're
Decrease.
increasing.
You're decreasing your equity account. So therefore, looking at your accounting model, how do you increase equity? With a credit. How do you decrease equity? With a debit. Okay? Because this one, I'm taking money away from my company. I'm decreasing the value of my company. All right, couple more. What kind of account is sales?
Income.
Yes, it's income. All right. Okay. What kind of category should sales belong to?
Current.
Is there such thing as a current revenue?
That's not specified.
So in your categories, you also have sales. So sales should belong on sales, correct?
Correct. Because in this case, right, what is my main core of operations? What kind of business activity am I looking at? I'm looking at a merchandising activity, right? So what is my main core of operations?
Sales.
Sales, right? Main core of operations, meaning what is the majority of where my income is generated? How am I making money? By selling a product. Okay, so in this case, it could be operating, or in this case, it could be specified as sales. Okay. Now, what kind of balance would sales have?
A debit balance?
All right, so revenues.
Because you're bringing in revenue?
Okay, so if you're bringing in revenue, right,
That would increase.
it would increase. So take a look at your accounting model. How would I increase revenues?
With the credit.
With a credit, because the other side is I must be receiving cash. All right, so that's where you guys have to kind of determine the difference between there. So exactly, like you may have to take context of, English and look it into terms of accounting. Okay, yes, we're generating income, but in this case, I'm increasing my revenues, right? I'm not looking at the logistics of what income is, revenues, right? Revenues is making money, right? In this context, I'm looking that I made a sale. Now, how did I get paid is going to be the second question, or it could be the first question, right? So in this case, I'm increasing my revenues with a credit, okay? And the counter or my double entry to that is I must have received cash. Cash is an asset, okay? All right, so in this case, what is a cost of goods sold?
It's an expense.
It is definitely an expense. Good. Now, what kind of expense is it? Operate. No, it's not operating. No.
It's a cost of goods sold.
Cost of goods sold, right? So, cost of goods sold is directly correlated with inventory. So, therefore, it has its own separate category because when you deal with sales, right, that's what that category is when it's directly correlated to sales. Where your main core of operations, right, doesn't have to be directly correlated to sales. It could be directly correlated with anything else, right? Is rent expense directly correlated to your inventory?
No, with the inventory.
No, no inventory. So in this case, this expense has its own separate category for cost of goods sold. Okay. Now, what kind of balance would cost of goods sold have?
Debit.
Debit. Good. Last two more. So, what about rent expense?
That would be an expense,
Mm-hmm.
operating expense,
It'd be an operating expense. Good.
a debit.
And it would have a debit balance. Okay. Last but not least, supplies expense. When you use your supplies, you have to find some kind of way to represent that you use these supplies. Or in this case, you can also purchase the supplies as an expense if you're going to get rid of them or use them immediately.
So it's an expense.
It is definitely, yes. Okay. What kind of expense?
Operating expense.
It's an operating expense.
Debit.
And it's a debit balance. Good. Okay. All right. So this one, just for understanding what these accounts, right? I will give you descriptions of what each account is, so you don't need to worry about that. So remember, each account that I test you on, right? Just read what the description is, right? Kind of figure out, is it something that you, so kind of divide it in between the different types of accounts by determining, okay, well, is this something that I own? If it's something that you own, then it's an asset, right? If I own furniture, right, then that's something I own. If it's cash, I own that money, right? Do I own a revenue? Do I own my sales? No, I earn them, right? If I sell a product, then I earn my sales. And then a good way to kind of know to understand that is most, if not except for long-term liabilities, every kind of current liability will have the word payable right behind it. Okay, so that's one way you can determine those are liabilities. Same thing with expenses, right? Except for cost of goods sold, of course. Every expense that you'll see will have the word expense right behind it. Okay, so those ones you can already determine those ones all automatically. Okay, but as far as your assets, that's where it's kind of like, oh, I don't know if I own it, or I don't know if this is something that is I can convert to cash. So that's where your assets are going to be kind of the fuzzy part, but your again, liabilities. If you see payable, boom, it's a liability. Revenues, it's pretty straightforward because we only know two things, right? Sales and other income. So as far as that, there's no real necessary things that I will test you on except for selling a product and other income. And then, of course, your expenses has the word expense in it. Okay?
Can you give me again an example for owner's equity?
Owner's equity. So, owner's equity, so a good example would be capital contributions. Okay, capital contributions is when you invest into your company. You add money to you add your own money into the company. That's going to be considered something that's owner's equity.
Thank you.
Mm-hmm. Okay. Any other questions? Okay. So, let's go ahead and go over the couple questions here, right? What does left mean?
A debit.
It means debit. Good. Okay. Okay, what does right mean?
Credit.
It means credit. Yes. And then here, number 11. Okay. If your company had a total assets of $125,000, all right, and a total liabilities of $45,000, what is your total owner's equity?
The 80,000.
D, 80,000. How did you figure that number out?
The total assets minus the liabilities.
Okay, good. Because the equation here is your assets equals your liabilities plus your equity, right? If I know that I have a total of 125,000, right? And I'm looking at my liabilities of 45,000, right? What can I add to 45,000 to get to a total of 125,000? Pretty straightforward, right? You add 80,000. So in this case, this is where I'm testing you on computing the accounting equation. Okay, so I will ask that question on the exam. Question number 12. Okay, what account types normally have a debit balance?
C.
C, assets and expenses. Yes. So take your accounting model, right? Your assets and your expenses normally increase on the debit side. Every other account increases with a credit. Okay, so good. Okay. Last question here. Okay. Which of the following account types are temporary accounts?
Revenue and expense, B.
Good. Revenue and expenses. Okay. So that's chapter 2 for you guys. Any questions here? Okay. As far as chapter 2, the first 10 questions are going to be this section here, right? Where I ask you a specific account, I give you a description, and you're going to tell me, you're going to determine what the account type is, what the category it belongs to, and what kind of balance it has. First 10 questions. Okay. I'll throw in a couple normal balance questions in there too. So as you can see here, right, because these are conceptual. So I may throw in what a left or credit is, normal balance, temporary accounts, all that. Okay. So that's chapter 2. No questions?
Okay, going back to the chart, just so I understand, like the little tip that you gave us. So asset is gonna be something that we own.
Mm-hmm.
Um, liability is always gonna have payable behind. Is that what you said?
Mm-hmm.
And then expense is always gonna have the word expense on it, kind of
Mm-hmm.
like rent expense or supplies expense.
Correct.
Um, and then an owner's equity is something that is invested into the company.
Correct.
Okay, and revenue, it's actually income is something that you earn, which is also related to revenue. Correct.
Mm-hmm. Mm-hmm.
Okay, thank you.
Mm-hmm. Okay. Okay. So that is chapter 2. Okay. And I'm going to go ahead and briefly go over chapter 3 because the only thing I really want you to get away from chapter 3 is just understanding how to journalize because that is what chapter 3 is. It's to journalize, okay? So I could possibly be testing you on the correcting entries method, right? So make sure that you understand how to do the reverse and re-entry, as well as the error cancellation. Okay. Now, like I said here, I only need you to understand how to journalize. Okay. Because I will ask you questions that will involve journalizing. So, for example, right, I could say for chapter 5, right, journalize the purchase of inventory. And I'll give you options. Options A could be you're going to debit purchase expense for $500. B could be you're going to debit purchase expense for $517. Whatever. And that's what I'm going to be asking you on the exam. So you will need to know how to journalize a transaction, okay? As far as the accounts that I've been showing you is what you're going to be looking at. So if I say journalize the purchase of periodic inventory, which is the only thing that we learned, you're going to do purchase expense, freight expense, and however you paid for it. Okay, whether you owed it on an account or you actually paid it with cash. Okay, so that's going to be number rule of thumb is that's the chapter 3 is going to be throughout the exam. Okay, especially when we dive into chapter 5, I will ask you to journalize. I could ask you to journalize the purchase of inventory, the sale of an item. Okay, I could ask you to do again, if you made a mistake in your journal, I can ask you to do the reverse re-entry or the error cancellation. I can also ask you to do a sales returns and allowances, a purchase returns and allowances. I could test you on the net and the gross method on both purchases or sales discounts, right? So make sure that you guys know that this chunk right here, there's not much to it to explain other than know how to journalize. So I'm gonna make sure that we go over chapter 3 real quick. Okay. So chapter 3. Okay. So how are we going to be journalizing? Once again, I'm just teaching you for now I already give you the accounts already. You don't need to come up with the accounts. So you don't need the chart of accounts, right? I'm not going to ask you many questions here. Okay? But when I talk about the journal, you guys need to be able to practice exactly how to compute a journal, right? Make sure you have the date. Make sure that when you are journalizing your entry, right, your accounts go first. Then your actual description of what happened comes last. Okay? So again, the way that we look at it is your debit accounts are going to go first. Okay? Right? And your debit accounts are usually left aligned. Okay? Then your credit accounts are going to be indented, right? And then again, it's going to be in an account that exists in your chart of accounts, okay? So your description, your actual description of exactly what you did. So, for example, I sold or I purchased 100 toys, right? That's going to be at the end, right? That's going to be in parentheses because when I organize my transaction, I'm organizing according to each account. And my description is going to just tell me what happened. If it's not, you're not obligated to have, a description if you don't want to. But just note this. If you are putting descriptions in place of your account, that's not how you journalize it. You're not going to be, there is no such thing as an account that's called 100 toys. Okay? So make sure that you understand that each line here, every debit is going to be associated with an account. Okay? So that's that right here, okay? Your PR, right? I'm not going to teach you too much about PR till we dive right into the class project or the coffee cafe, which is our practice of journalizing. We're going to take a fictitious business and we're going to practice recording a transaction. The chart of accounts is going to be used for your journal to make sure you make a reference point. In this case, like I said, I'm not going to test you on this, right? But we have been practicing through the rest of our exercises, okay? And of course, we need to make sure that when we debit, right? Let's say we spent money. The first example, right? I spent $500 for furniture, right? So in this idea, I bought furniture, so I increased my furniture account. But in order to do that, I had to lose cash or decrease my cash flow. So that's how we're measuring it. We're measuring it in terms of value, dollar value. I'm not saying I bought 4 chairs and a desk, right? I'm saying I bought $500 worth of furniture, which includes 4 chairs and a desk, okay? Which I can put that down here in my description, all right? But here we also need to say we need to have an equal and opposite idea here, right? Our debits must always match my credits. Now, again, if you look at this example here, I can split my debits into multiple accounts as long as I have the idea that at the end of my journal, if my total debits match my total credits, then that's the goal. Okay? Again, that's all I need you to get away, right? Transaction analysis, right? In this case, I'm already give you the scenario so you know that every scenario that I give you, you will journalize. Okay? So that's all for chapter 3 because I don't need you to know the ledger yet because that's when we dive into the fictitious business, okay? But what I do want to get away from here is you guys understanding the error cancellation and the different methods to correct the entries because I will test you here, right? So you do need to know using the reverse reentry and also using the error cancellation, okay? All right. Any questions for chapter 3? We're going to go ahead and go over some questions and then we'll take a break here. So let's see. Question number 14. Okay. When journalizing a transaction, which statement is true?
That's A.
A. Debits equals credits. Yes, that is true. Right? Debits are not recorded last. Okay. Credits are not recorded first. And descriptions are account names only. No. Okay, so A is true. Your debits must always equal your credits. Okay. See here, question 15. What are the methods used to correct entries in the journals?
Letter D.
Letter D. The B and A and B only, right? Error cancellation and reverse reentry, right? We just went over this. No such thing as the cross it out method, okay? So good. So let's go ahead and see here. Okay, we have, okay, question number 16 says that You made a purchase of office supplies for $56 cash, okay? You recorded in your books office supplies for $65, okay? Correct the error entry using both methods. So the first one I want you to do is the reverse and re-entry method, okay? So my original journal, right? I purchased office supplies for $56, but in my books, I wrote that it was 65. Okay? So how do I do the reverse and re-entry, which is the first one?
First, first you recorded the way you made it before you made the error with the $56.
Okay, so in this case, I've already recorded. I don't need to record it again.
Then the second one you'll then you'll put it in the right way.
Okay, so the first one, what was it again?
Record the entry the way that it was wrong. With the $56 in cash. 2019 description. Um,
Okay, so
the purchase.
you're not going to record it for the wrong amount. That's not the first entry. It's not going to be recording it for the wrong amount.
So you said what do you do first?
Mm-hmm.
Correct the error in the entry using both methods.
Okay, so the first one is going to be reverse and re-entry. Now, I see. Okay, so you're trying to reverse the transaction. Now, how do you reverse the transaction?
Can I try it?
Mm-hmm.
Okay, cash for $9 debit and purchase expense for $9 credit.
Okay, that is the error cancellation method.
Mm-hmm.
Now, in this case, that's the error cancellation method. So that's not the reverse and re-entry. So in this case, right, error cancellation is where you find the difference between the two numbers, right? The difference between 56 and 65 is $9. So when we're doing the error cancellation, right, the one danger that you have here is you need to determine which account is over and which account is under. Okay? So in this case, if I journalized it in my books as 65 instead of 56, right? In this case, do I have too much cash or do I have too much office supplies? So in this case, Nathan said that we spent too much money, right? We need to give back the money back to us because in this case, right? I only spent $56, but in my books, I said that I spent 65. So in this context, he is correct. You are going to be debiting cash because that's the money that you put too much money into the pile. So you're going to be getting that money back. And in this case, we recorded way too much office supplies. Okay? We went over office supplies by $9. So in this case, we need to take $9 out to make sure that it reflects as 56 instead of 65. Okay, so that's the error cancellation method. Okay, how do we do the first one though?
Quick question about
Yes.
this whole the whole transaction. So how come we just don't like do the error cancellation? So if it was supposed to be $56 and I put in $65, why can't I just do the debit and credit for the full for the 465 and then correct, then do the reverse and re-entry on the other hand for the 56? Why is it just the dollar difference? You understand what I'm saying? Why is it just the $9 difference?
Okay, so that's
Not
why
the whole
that
thing.
because that's why there's two different methods. You can only choose one to correct. So in this case, right, you have the choice, right? Would you rather reverse the entry and then re-enter it in the correct amount, or would you rather just find the difference and record it that way? Both methods are accurate, okay?
Okay.
But the only thing is, like in this case, right, I'm teaching you both because you have the choice to choose between the two methods, right? Which one works best for you? And in this case, right, Nathan says, well, I like the error cancellation because all I got to do is just write one entry in there, and I said the difference is $9. He likes it that way, right? But the only thing is that this one has dangers because what if you accidentally put for $9 in the wrong account? Then you made a double error, right? Then you have to make another journal entry to fix the error that you were trying to fix the earlier. So if I were to say office supplies for $9 in cash, now my office supplies is outstanding for $74 instead of 65 or instead of 56. So you have to be very careful when you're doing this. But I understand what you're trying to say. You're asking me, well, why do you have to do both? You don't do both. You have to choose one or the other. And in this case, he chose to do the error cancellation, which is to find the difference between the two. But I'm asking you now is okay, if I don't trust that method, then let's go ahead and do this method right here where I reverse the transaction and re-enter it in the correct amount.
So that would be cash for 65
Okay, cash for 65.
and then office supplies for 65 also.
Okay.
Then you will re-enter office supplies for 56 and cash for 56.
Okay. Good. Okay. Now, the best way to understand this is, okay, this is perfect. This is accurate. This is correct. Okay. This is when we are taking a look, right? If I purchase office supplies and I paid with cash, okay, whatever. So therefore, I originally record my entry, right? Now, the best way to understand this is take it back to the physical store, return it, right? If I'm going to return it, I should be getting cash and I should be getting rid of my office supplies. And then the next entry, right, is me, I'm going to repurchase it back for the correct amount. That's the best way to understand the reverse and reentry. And it should be the best method to use because, like I've mentioned before, right, this one gives you a more accurate one because you will least likely to make a mistake here. Because here, we just reverse the transaction, right? We undo our mistake and we enter it in again for the correct amount.
So as Kim was saying, to enter this information. So let's say that we bought those supplies like 2 days ago.
Mm-hmm.
The first transaction will cancel the transaction that we recorded 2 days ago. Is that correct?
Okay, so yes.
So let's say that today is Tuesday.
Mm-hmm.
Let's say that on Friday we enter in our books that we purchase supplies for $65.
Mm-hmm.
Today, Tuesday, when we re-enter the first, when we journal the first transaction, that's gonna cancel the transaction that we recorded on Friday, and then we're gonna enter the correct amount. Correct?
Correct. That's exactly what this
Right.
is.
You understand? Okay. Thank you.
Yes, that's exactly right. Okay. Now, in context, that's exactly right. And there's two methods, right, to correct the journal entry, and you can choose between them. Now, you can't do both of them because then you're double canceling them out. Okay, and that's not what we want. You can only choose one out of the two to correct a journal entry. Okay? So yes, that's the perfect and best way to understand it, yes. Now again, you can also be like, well, I made a mistake. Okay, well, this one you have to be really good at accounting and really understand the flow of transaction, right? In this case, error cancellation, right? It's a tricky one because you could actually enter in the wrong amount in the wrong account, okay? So here, error cancellation, right? You're just finding the difference between the mistake, so the 65 versus the 56, right? Which we find is a $9 difference. Now the question is, you have to understand, if I originally only bought $56 worth of supplies and I journalized it as 65, do I have too much money, or did I spend too much money, or do I have too much office supplies? In this case, I journalized that I spent too much money and that I also have too much office supplies. So in this case, I need to say, well, I need to get my money back, $9, and I need to decrease my office supplies account by $9. Okay. So again, error cancellation is a tricky one, but again, if it makes it more comfortable for you, you only need to do one entry, and that is to find the difference between the two. Okay, right. But the best way to do it should be the reverse and the re-entry, because this one you could see the transaction, right? You're canceling the first transaction, and then you're re-entering it in for the correct amount. Any questions there?
No.
Okay. Last but not least, question number 11. What is the difference between the general journal and the general ledger?
B.
The general ledger only lists daily business activities and transactions. That sounds like a journal. No?
C?
C, as in cat?
Yes.
Yes. The general ledger is a list of all of the accounts with their account balances. Yes. So again, when we look in chapter 3, right? Okay. It looks identical to a regular journal. The only difference is that we have account balances, right? In this case, we use the ledger to determine how much money we have in each account. So for example, your checking account, right? You should run your general ledger, which gives you your account balance at any given time. So in this case, when we journalize a transaction, right, we post it to the ledger to let us know how much money we have in our bank account at all times. So that's the difference between the journal and the ledger, right? The ledger, right, will have all of the accounts with their respective account balances. Okay. Good. All right, so we will take a break. We'll go over chapter 4, and then we will call it a day. Okay, so right now it is 10:05. So go ahead and take a 20-minute break and be back at 10:25.